Something remarkable is happening with Russia's gold strategy that most Western analysts are completely missing. While everyone focuses on sanctions and their immediate economic impacts, Russia has been quietly implementing a monetary strategy that could fundamentally alter global finance. The numbers tell a story that challenges everything. We think we know about economic warfare and currency systems. Russia's official gold reserves have declined from approximately 2,300 tons to roughly 2,100 tons over the past 18 months. Western media celebrates this as evidence that sanctions are forcing Russia to liquidate strategic assets. But here's what they're not telling you. Despite holding less physical gold, the total value of Russia's gold reserves has reached all-time highs. Gold prices have increased from $1,800 per ounce to over $2,400 per ounce during the same period. This 33% price appreciation has more than offset the roughly 8% decline in physical holdings. Russia's gold reserves are now worth approximately $168 billion, compared to $145 billion before the sanctions began. But the real story isn't about accounting gains on existing reserves. It's about how Russia is using gold as the foundation for a completely different monetary system. While Western nations focus on freezing Russian dollar reserves and limiting access to SWIFT payment networks, Russia has been building alternative financial infrastructure that doesn't depend on Western currency systems at all. The Central Bank of Russia has been purchasing gold from domestic miners at above-market prices, ensuring that Russian gold production stays within Russian control rather than being exported for foreign currency. This policy creates a closed-loop system where Russian gold supports Russian monetary policy rather than contributing to global gold markets dominated by Western financial centers. More significantly, Russia has been working with other BRICS nations to develop gold-backed payment mechanisms that could operate independently of dollar-based international finance. These aren't theoretical discussions or future planning sessions. These are operational systems being tested and refined through actual trade transactions. The BRICS payment system represents something unprecedented in modern international finance. Unlike previous attempts to create dollar alternatives, this system is backed by physical commodities rather than fiat currencies. Gold provides the anchor, but the system also incorporates other commodities like oil, wheat, and critical minerals that BRICS nations produce in abundance. China holds approximately 2,000 tons of official gold reserves, though many analysts believe actual holdings may be significantly higher. India's gold reserves have grown steadily, and the country remains the world's largest gold consumer. Brazil controls substantial mining resources. South Africa remains a major gold producer despite declining output in recent years. Combined, BRICS nations control significant portions of global gold production and reserves. But more importantly, they control the physical commodities that drive global economic activity. This control provides the foundation for a payment system that doesn't require Western financial intermediation. The mechanics of the BRICS payment system challenge fundamental assumptions about international trade settlement. Traditional systems require converting local currencies to dollars, processing payments through Western banking networks, and accepting the oversight and potential sanctions that come with dollar-denominated transactions. The emerging BRICS system allows direct settlement between member nations using gold-backed digital units. These units are linked to physical commodity baskets, providing intrinsic value that fiat currencies lack. Trade partners can settle transactions without converting to dollars or accessing Western financial networks. Early implementations have focused on energy transactions between Russia and other BRICS members. Russian oil and gas exports can be paid for using gold-backed units that recipients can either hold as international reserves or convert to physical commodities through the system's settlement mechanisms. This approach provides multiple advantages for BRICS members. They avoid dollar conversion costs and exchange rate risks. They bypass Western banking systems that could freeze or restrict their transactions. They build reserves backed by physical assets rather than promises from foreign governments. For Russia specifically, the gold-backed payment system provides protection against sanctions that target traditional financial assets. Western nations can freeze dollar reserves held in Western banks, but they cannot freeze gold held in Russian vaults or commodity-backed digital units held in BRICS payment systems. The timing of these developments coincides with broader changes in global economic relationships. Western sanctions have accelerated the formation of alternative trading blocs and payment systems. Nations that previously relied on Western financial infrastructure are now seeking alternatives that provide greater autonomy and security. The European Union's decision to freeze Russian central bank reserves held in Western institutions sent a signal to other nations about the risks of holding reserves in Western financial systems. If the West could freeze the reserves of a major nuclear power, it could certainly freeze the reserves of smaller nations if political relationships deteriorated. This realization has motivated not just BRICS members, but other nations to diversify their reserve holdings and reduce dependence on Western financial systems. Central banks worldwide have been increasing gold purchases and reducing dollar reserve percentages since the Russian sanctions began. The gold market itself reflects these changing dynamics. Central bank purchases have reached levels not seen since the 1960s. Official sector demand now represents approximately 20% of annual gold purchases, compared to historical averages around 10%. But the demand composition has changed dramatically. Western central banks are not major purchasers. The buying is concentrated among Asian, Middle Eastern, and Latin American central banks that are actively diversifying away from dollar-denominated reserves. China has been the largest official purchaser, adding approximately 300 tons to reserves over the past 2 years. Turkey, India, Poland, and Singapore have all made significant purchases. Even traditionally, Western-aligned nations are increasing gold allocations as insurance against financial system instability. The private sector response has been equally significant. Wealthy individuals and institutions in emerging market nations have increased gold allocations substantially. They're not buying gold as speculation or portfolio diversification. They're buying it as protection against potential restrictions on their access to Western financial systems. This shift in demand patterns supports higher gold prices while changing the geographic distribution of gold ownership. More gold is moving from Western institutions to Eastern institutions. More gold is being held by entities that view it as monetary assets rather than commodity investments. Russia's strategy leverages these broader trends while accelerating them through policy initiatives. By linking gold reserves to payment systems and trade settlements, Russia is creating practical alternatives to dollar-based systems while providing other nations with working examples of how to reduce dollar dependence. The network effects of this strategy could prove more important than the initial scale. Once BRICS payment systems demonstrate reliable functionality for major trade transactions, other nations will likely seek access to similar capabilities. The system could expand beyond BRICS to include other nations seeking alternatives to Western financial systems. Iran has already expressed interest in joining BRICS payment mechanisms. Saudi Arabia has been exploring options for non-dollar oil sales. Turkey maintains relationships with both Western and Eastern payment systems. These nations represent significant economic activity that could shift away from dollar-based settlement. The implications for Western financial dominance are profound. Dollar hegemony depends on the absence of viable alternatives for international trade settlement. If BRICS payment systems provide reliable alternatives backed by physical commodities, the necessity of using dollars for international trade diminishes significantly. This does not mean the dollar will collapse immediately or lose its role as the primary international reserve currency overnight. But it does mean that dollar dominance could erode gradually as alternative systems gain credibility and adoption. The Federal Reserve's response to these challenges has been limited by political and practical constraints. Raising interest rates to defend dollar attractiveness also damages domestic economic conditions. Lowering rates to support domestic growth reduces dollar attractiveness relative to hard assets like gold. More fundamentally, the Fed cannot print gold or commodities. If international trading partners prefer settlement systems backed by physical assets, monetary policy tools become less effective for maintaining currency dominance. The European Central Bank faces similar constraints with the additional complication of managing monetary policy for multiple nations with different economic conditions and political priorities. The ECB cannot respond to challenges to Western financial dominance with the same unity of purpose that characterizes BRICS payment system development. Western financial institutions are beginning to recognize the competitive threats posed by alternative payment systems. Major banks have started exploring their own commodity-backed payment mechanisms and blockchain-based settlement systems. But these efforts face regulatory constraints that don't apply to BRICS initiatives. More critically, Western systems still depend on Western currencies and Western financial institutions as intermediaries. They cannot provide the independence from Western oversight that BRICS systems offer to participating nations. The insurance value of gold reserves becomes more apparent as geopolitical tensions increase. Russia's experience demonstrates that traditional financial assets can be frozen or restricted during conflicts, but physical gold held domestically provides more reliable value storage. Other nations are drawing similar conclusions from observing recent sanctions applications. Gold provides insurance against financial sanctions in ways that foreign currency reserves cannot. This insurance value supports demand even when gold does not provide current income like bonds or dividends like stocks. The commodity backing for BRICS payment systems extends this insurance principle to international trade. Nations can accumulate reserves backed by physical commodities rather than promises from foreign governments. These commodity-backed reserves provide inflation protection and sanctions resistance simultaneously. Trade settlement through BRICS systems reduces counterparty risk for participating nations. They don't depend on Western banks remaining willing and able to process their transactions. They don't face risks that Western governments will restrict their access to financial systems for political reasons. The energy sector provides the most obvious application for alternative payment systems. Energy transactions represent massive value flows that have traditionally been dominated by dollar settlement. BRICS nations control significant portions of global energy production and consumption. Russian energy exports to China and India have already begun using alternative settlement mechanisms. These transactions demonstrate that large-scale international trade can occur without dollar intermediation when both parties prefer alternative arrangements. The agricultural sector represents another major opportunity for BRICS payment systems. Russia and Brazil are major agricultural exporters. China and India are major agricultural importers. Direct settlement of agricultural trade between these nations reduces costs while providing greater autonomy from Western financial systems. Mineral resources provide additional opportunities for commodity-backed settlement systems. BRICS nations control significant portions of critical mineral production, including lithium, copper, nickel, and rare earth elements. These materials are essential for renewable energy systems and advanced manufacturing. By settling mineral trade through commodity-backed systems, BRICS nations can maintain greater control over critical supply chains, while reducing dependence on Western financial intermediation. This control becomes strategically important as competition increases for access to critical materials. The technological infrastructure supporting BRICS payment systems continues developing rapidly. Blockchain technologies provide secure, transparent transaction processing without requiring centralized Western intermediaries. Digital currencies backed by commodity baskets provide programmable money that can automatically settle complex multi-party transactions. These technological capabilities enable financial services that couldn't exist under traditional correspondent banking relationships. Smart contracts can automatically execute commodity deliveries when payment conditions are met. Multi-currency baskets can provide stability while reducing dependence on any single national currency. The legal frameworks supporting alternative payment systems are evolving alongside technological capabilities. BRICS nations are developing standardized legal structures for cross-border commodity settlements that don't require Western legal system oversight. These legal frameworks provide predictability and enforcement mechanisms for international trade conducted outside Western financial systems. They're not trying to replace existing international law, but rather to provide alternatives when Western systems become unavailable or unreliable. The momentum behind these changes appears to be accelerating rather than moderating. Each successful implementation of alternative payment mechanisms demonstrates feasibility while providing participating nations with practical experience in operating outside Western financial systems. Russia's gold strategy represents both symptom and catalyst for these broader changes. The increase in gold reserve values, despite declining quantities, shows that physical assets provide better sanctions protection than financial assets. The development of gold-backed payment systems shows how alternative monetary frameworks can reduce dollar dependence. The broader implications extend beyond any single nation or conflict. The international monetary system is evolving toward greater diversity and competition between different currency and payment systems. This evolution reduces the advantages that dominant currency nations have enjoyed for decades. Gold's role in this evolution combines its traditional monetary functions with modern technological capabilities. Digital currencies backed by gold provide the convenience of electronic settlement with the security of physical asset backing. The BRICS payment system development represents more than technological innovation or political posturing. It represents a fundamental shift toward monetary systems based on physical assets rather than government promises. The shift could prove more durable and significant than the immediate geopolitical circumstances that accelerated its development. Russia's experience with gold as sanctions protection provides a template that other nations can adapt to their own circumstances. The key insight is that physical assets held domestically provide more reliable value storage than financial assets held in foreign institutions. The question is no longer whether alternative international payment systems will develop. They are already operational and expanding. The question is how quickly they will gain adoption and what effects they will have on existing monetary arrangements. For investors and observers of international finance, these developments suggest that the era of unchallenged Western financial dominance is ending. The transition toward a more multipolar monetary system is accelerating, driven by both geopolitical tensions and technological capabilities. The gold market reflects these changes through sustained high prices despite economic uncertainties that traditionally would have supported dollar strength. Central bank demand and emerging market accumulation provide price support that appears likely to continue, regardless of short-term fluctuations. Russia's gold strategy demonstrates that even nations facing unprecedented sanctions can maintain monetary sovereignty through appropriate asset allocation and payment system development. This lesson is not lost on other nations seeking greater independence from Western financial systems. The implications will unfold over years rather than months, but the direction appears clear. International monetary arrangements are becoming more diverse, more competitive, and less dominated by Western currencies and institutions. The numbers behind Russia's gold reserves tell this story clearly. Less physical gold held in national reserves, significantly higher total values. Reduced dependence on Western financial approval, but increased monetary sovereignty and strategic autonomy,